Hi, I am Penny. Most people who start trading lose money, not because trading is impossible, but because nobody teaches them the real rules. Today, I will walk you through what actually separates winning traders from losing ones. Study after study on retail trading accounts finds the same pattern. The large majority of day traders lose money over time. This is not opinion, it is what the data consistently shows. But here is the good news. The traders who succeed are not smarter or luckier. They follow a specific set of principles, 6 pillars that anyone can learn. Pillar 1. Psychology. Your biggest opponent in trading is not the market. It is your own brain. Fear makes you exit winners too early. Greed makes you hold losers too long. After a big win, many traders feel invincible and take a much bigger risk on the next trade. This overconfidence is one of the fastest ways to give back months of gains in a single day. The traders who last treat every trade the same size, whether they just won 5 in a row or lost 5 in a row. Emotional consistency is a skill you build, not a personality trait you are born with. Pillar 2. Risk management. Professional traders do not try to avoid losses. Losses are part of the game. What they control is how much they lose on any single trade. The standard rule: risk no more than 1 to 2% of your total trading capital on any single position. Risk 10% per trade instead, and just 7 losing trades in a row can wipe out most of an account. A stop-loss order is a predetermined price where you exit a losing trade automatically. Professionals treat their stop-loss as non-negotiable, set before entering, and moved only to reduce risk, never to increase it. Risk-to-reward ratio matters more than win rate. With a 2-to-1 reward-to-risk ratio, a trader only needs to win about 34% of trades to break even, and any edge above that becomes real profit. Plan 3. The trading plan. A trading plan defines exactly when you enter, when you exit, and how much you risk, written down before you ever place the trade, not decided in the heat of the moment. Backtesting means testing a strategy against historical data before risking real money on it. If a strategy has not proven an edge on past data, there is no reason to expect it will work going forward. Overtrading, placing far more trades than your strategy calls for, quietly destroys accounts through transaction costs and impulsive decisions. Boredom, not opportunity, is often the real reason for a bad entry. Revenge trading is trying to immediately win back a loss with a bigger, riskier trade. It almost always turns one manageable loss into a much larger one. Plan 4. Discipline. Discipline means following your written plan exactly when it is hardest, when you are down money, tired, or convinced this one trade is different. Every professional trader keeps a trading journal, recording the entry, the exit, the reasoning, and the emotion behind every trade. Patterns in your mistakes only become visible once you write them down. Reviewing a losing trade honestly, without blaming the market, is how traders improve. Was the entry wrong, or was it a good trade that simply did not work out? Those are 2 very different problems. Pillar 5. Realistic expectations. There is no strategy that wins every trade, and no legitimate path to consistent, extreme returns overnight. Anyone promising that is selling something, not trading. Sustainable trading is built on small, consistent edges compounded over years, not on doubling an account in a month. A steady 5 to 15% a year, compounded, turns into extraordinary wealth over a couple of decades. Leverage lets you control a large position with a small amount of capital, and it multiplies both gains and losses equally. 10-to-1 leverage turns a 10% market move against you into a complete loss of your capital. In January 2015, when the Swiss National Bank suddenly removed its currency peg, some retail traders lost many times more than they had deposited within minutes, a real reminder of what unmanaged leverage can do. Diversification only works if your positions are not all reacting to the same underlying risk. 10 different stocks in the same sector can crash together just as easily as one. Pillar 6. Continuous learning. Markets change. A strategy that worked in a calm, trending market can fail completely in a choppy, sideways one. The skill is knowing the difference between adapting your approach to new conditions and abandoning your strategy the moment it hits a normal losing streak. Every successful trader experiences drawdowns, extended periods of losses even within a winning strategy. What matters is whether the drawdown stays within the risk limits set in the plan. Capital preservation is rule number 1 for a reason. You cannot compound gains from an account that is already empty. Protecting what you have comes before growing it. The biggest difference between professional and amateur traders is not the strategy. It is that professionals judge themselves on whether they followed their process, not on whether any single trade won or lost. Be skeptical of paid signal services, gurus showing screenshots of gains, and any system promising guaranteed profits. If it worked reliably and consistently, it would not need to be sold. A simple pre-trade checklist works better than talent. Does this trade fit my plan? What is my stop loss? What is my position size? What is my risk to reward? If you cannot answer all 4, do not take the trade. Trading success does not come from one lucky trade. It comes from psychology, risk management, a plan, discipline, honest review, and patience, repeated for years. Subscribe, and I will keep teaching you the real rules every week.